Morning, everybody. Thanks for jumping on here with us today. My name is Jen Galt. I'm the Education Program Manager for ACI, and we are excited to have one of our members here with us today, Struxtion, who will be talking about how to effectively finance your construction business. And before I turn it over to these gentlemen, I just wanted to go over a few housekeeping items. If you would remain muted throughout the presentation, just so everybody can hear properly, that would be appreciated. The folks here will have a presentation for us. So if you'd like to select the speaker view, I think it's in the top right-hand corner of your screen. To be able to best see that and follow along, feel free to do so. And if you have questions as we go through the presentation, feel free to drop them in the chat and we will get those answered for you. And then we'll also be recording this. It'll be housed on our YouTube channel, so you can go back and watch it and share it with any of your colleagues who weren't able to make it today. So I'm going to quickly introduce our two speakers, and then I will turn it over to them. So we have Gregg Lund with us and Zach Fox from Struxtion. So Gregg is the CEO of Struxtion, and over the past 20 years, he has originated and structured over 500 million of capital transactions, including debt, equity, and M&A related to corporate and real estate assets. And Gregg has also been the CEO for privately held enterprises, as well as served in a CFO capacity for several diverse holding companies. And Gregg launched Struxtion in 2019 with the mission to utilize technology and information to lower the cost of financing in the commercial construction industry. And then Zach Fox is the Director of Relationships at Struxtion. He has 5 years of experience in finance with an MBA with a focus in finance from the University of Cincinnati. He's provided top of liquidity to mid-market companies with revenues ranging from 2 million to 900 million, and a proud Costco executive member. So I will go ahead and turn it over to Gregg.
Nice, Jennifer. Thanks so much. I appreciate it. I wish I could bring you everywhere I go. You do my introduction better than I do. So thank you for that. So what I'm going to do here is start sharing my screen. I'd like to walk you through a little bit of a presentation. It should take about maybe 25 to 30 minutes, and then open it up for any kind of Q&A. So let me share. You can see that, right? Yep. All right, so we have, I'm gonna look at this here. So Jennifer did a great job sharing with everyone who we are. So I'm gonna jump right into the details. So, this is kind of our perspective. And the construction industry is a hard-fought industry. Actually getting access to jobs that many subcontractors want isn't easy. But once you do, it should be a moment of celebration, a moment to really feel like you could put your best foot forward and show off the talented team of folks that you have. Unfortunately, for so many people, either in the bidding process and trying to understand what that capital constraint may look like is a challenge, or actually winning the work and then having to execute on the capital side can often be a challenge. And so, it's kind of congratulations. Now what? Do you have enough working capital to actually execute on the process? And so when we really look at it, we share this kind of mindful piece, which is you're not alone. In the commercial construction industry, subcontractors in particular have the longest days outstanding, really, of any mature industry at 84 days. This was a PwC survey from about a year ago. So 84 days would simply suggest that you need to have about 3 months worth of your revenue on hand from a working capital perspective to, essentially execute on kind of any bidding. Another survey that was done actually by QuickBooks suggested that 49% of contractors don't get paid on time. So one of the things here that I think is incredibly meaningful, it's not to suggest that subs don't get paid, because clearly that would be problematic, but it's to suggest that they don't get paid on time. And I think anybody who's been in the subcontracting space for a long time knows that that is a bit of an unfair statement anyway, because paid on time is only meaningful if you have payment terms, and with paid when paid contracts, those don't really exist. Capital can be costly. Obviously there are sources of capital with traditional lenders, but when you're not playing in that space or that's not meeting your needs, other sources of capital can be incredibly expensive. So really, when we look at the cash conversion cycle, many of you know this as well as certainly we do. Subcontractors beginning work and executing on that work for 30 days, finally getting to the point where they get to invoice the subcontractor. The subcontractor gets to invoice the GC. The general contractor has a couple weeks worth of time to ultimately put together the payment applications from all of the different subcontractors to then pass that off to a developer. I've been on this side of the table quite a lot in my career, working for developers, receiving the general contractor pay apps. On that side of the table, developers have another couple weeks worth of work. They're validating what's been done in the field. They're also including their soft costs, calculating their interest expense and putting that all into a payment application that finally gets submitted to the bank. The bank receives that payment application, advances funds to the developer, who ultimately advances those to the GC, and the subcontractor finally receives payment. And so when we look at this incredibly long, arduous, cumbersome, time-consuming process, we end up at essentially a cash conversion cycle of nearly 80 days. And so in many industries, businesses focus on the cash conversion cycle, and really the definition there being, after I start laying out my first dollars to either pay for labor or procure inventory, how long does it take for me to kind of receive those dollars back from the valuable good or service that I produced, and to ultimately get paid by the end customer. And so in my experience, 50 days is probably kind of best case scenario. Again, being on both the general contractor and the developer side very frequently in the past, that is an incredibly fast turnaround. A lot of that really focuses on the bank's process and how banks take risk off the table. So ultimately, banks are taking risk off the table to a point where they can afford to lend capital to developers at a fairly low rate. And so once they not only receive the payment application from the developer and they get to validate that against the budget, they do a couple other things that take considerable amounts of time. They send a third-party bank inspector out to confirm that the work that's been in place has been done, and they also run title to assure that there have been no liens filed from previous pay apps. So the way I always look at this is that this cash conversion cycle that's so long for subcontractors really benefits the general contractors by taking risk off the table. It benefits the developers by taking risk off the table, and ultimately clearly benefits the developer's bank by taking risk off the table. The one party in that entire value chain that it doesn't support and help is the subcontractor, who, by the way, has continued to work and continued to essentially bear those expenses. So when we want to look at kind of a typical cash flow, and I did this generally at a project level, and I used kind of round numbers so that we can have the numbers all generally make sense. If we look at a general contract value of $1 million with gross profit contribution margin to the business of 20%, we would ascertain that the project cost is about $800,000. We assume 10% retainage, which is pretty much the industry norm, and a project duration of 18 weeks, and payment from the GC 50 days after submittal. We see this fairly horrific graph. And basically what this graph suggests is that from the very beginning of the project to the time in which the subcontractor is able to kind of fully execute on where they stand, be paid on all invoices, ultimately have paid off all of their vendors, paid off all of their labor, and reap the benefit of their profit, it can take up to 32 weeks because of the long payment cycles associated with this arduous cash conversion process. And so when we really look at what the results suggest, is it suggests that the cash required to execute on this project for a subcontractor executing $1 million worth of work over essentially a 4-month time period would be $489,000 in working capital, and that'll ultimately yield $200,000 in gross profit. And so one of the things that I think is interesting, and we want to explore a little bit more as we go through this, is this ratio of the cash required to execute on a bid and the total GP produced. And so in this example, you need almost 2.5 times the amount of gross profit that would be yielded from this project to execute on this contract. And so, one of the perceptions here, and we'll get into more detail about this, is really twofold. There is the cash conversion cycle in terms of length, and then there's also the cash conversion cycle in terms of depth. And what I mean by depth is how much money has to be outlaid by the sub to get through that period of time that is the cash conversion cycle. So, really when we look at options to reduce the cycle, we start with, what we all know is the material side of the purchasing. We suggested, and we all know that the world has changed a little bit with regard to materials purchasing today. Hopefully it goes back to something that's a little bit more normal in coming months. So we layered in that, potentially you would have to pre-order materials 30 days in advance. We did not in this analysis suggest that they have to be paid in advance. They just have to be paid at the time of delivery. We suggested a 30-day billing cycle on the work side, and then a 50-day payment cycle from the days in which the invoice is ultimately submitted to the general contractor. And so when we start really layering that in, you're carrying the cash carry on the material side is 80 days. The cash carry on the labor side is, roughly 80 days from when you start paying labor. Of course, over that period of time, you're doing it either weekly or every other week. And then, of course, you're essentially supporting that entire outlay of both materials and labor for more than 50 days. Now, mind you, this is all at the project level. As we all know, subcontractors also have general expenses at the corporate level, which are also requiring cash to operate your business, and those are not actually factored in here. And so what really are our options to reduce the cash conversion cycle? And the first option is around negotiating supplier payment terms. And so, of course, the longer you can get, as many of you know, with your suppliers, the less carry you have on the material side. There are some challenges clearly with this, which are for newer subs or subs that have not had the benefit of extending a lot of credit with a supplier. There could be limits and caps on how long those payment terms will be extended for, and in particular, what dollar amount they'll be extended to. And so a long enough period of time may help you from a cash carry perspective on that one project, but may make it difficult to layer on additional projects because you don't have the benefit of additional availability from your suppliers. And I think one other thing to always kind of think about when it comes to supplier payment terms is really the pricing that you're getting as a subcontractor predicated on their perceived either risk or the amount of time that you're asking for to get paid. A lot of subs that we've talked to when we've said, well, hey, if you want to take on a project that's larger than what you think your current working capital capacity is, how would you do that? And many times they suggest that the first thing that they do is they go to the supplier and they say, hey, I'm going to get this great project. I want you to be my supplier on it, but I need you to give me 60 days, or I need you to accept a paid when paid term, just like I'm going to. In the case that a supplier may actually agree to that, we could all acknowledge that there is some risk factor built in there and there's some carry cost built in there, which ultimately is additional project expense and being subtracted from the gross profit. When we look at, well, how can we ultimately maybe make that trough on the cash conversion cycle not as deep? How can we utilize somebody else's money to take out the depth of that trough? Of course, there's financing options. Financing options, which we're going to talk about in more detail here, really revolve around traditional banking solutions, factoring solutions, and of course, credit cards, which have been a kind of favored tool of many subcontractors, at least to pay their suppliers. And then lastly are, early payments, right? If we can bring in the payment cycle from 50 days to 40 days or less, we clearly reduce the amount of time on the cash conversion cycle. However, this is also a challenge and does not come with little expense. So, for us, it really is to drill down on the existing financing options. I think really kind of shortening the cycle is a very challenging thing to do. And it will come over time. And we believe that having good financing infrastructure will actually help you do that, in particular with your commercial suppliers. But when we go through the existing, I would say, kind of options and what those mean from a rate perspective, we clearly start with conventional debt, which is your best case scenario, right? The gold standard. In today's market, fairly inexpensive, 4 to 5%. However, it is incredibly difficult to obtain. I always use the analogy that banks or they want to give you an umbrella when it's sunny out and they want to take it back when it's raining. And what we've learned from a lot of our surveying and conversations with subs is those subs that have good lines of credit are generally the ones that don't actually need them. They've got robust balance sheets and they really secure a line of credit as a safety net, but they don't but they don't use it effectively like subs that may be a little bit earlier in their development as a business and actually need the working capital. The process is long. Banks are not quick to respond. And unfortunately, subs that are looking for access to working capital and need it quickly cannot wait what has now become a 90 to 120 day cycle from a bank just to get an answer. They're generally adverse to construction. We'll get through a couple of those reasons in a little bit more detail, but it's certainly not a favored industry within the banking sector. Some folks and subs that we've talked to have suggested that when they have had to get access to cash, they have looked at HELOCs tied directly to their personal credit or their own home. And then you really move very far upstream. Traditional AR factoring. We've researched this extensively. There is a rate sensitivity to it clearly, but what we will say probably being almost more impactful in terms of its usage broadly across the construction industry is it's poorly perceived. The theory that a sub would go to a general contractor and say, hey, by the way, I've sold your invoice to create cash, certainly becomes an issue of reputational risk. The other piece of this is that it's very difficult to manage. So a traditional AR factoring company that is acquiring an invoice on behalf of a sub ultimately has a lot of communication with the general contractor, and there's a fair amount of paperwork that has to ultimately be implemented. Credit cards, again, many conversations with subs, American Express being kind of a tool that subs use to ultimately pay their material suppliers. They're reaching limits with their material suppliers that they need to get paid down, or they're getting pressure from the material suppliers and don't have the cash to pay. This kind of opportunity to try to time material payments on credit cards through the cycle, something that we've seen used. And unfortunately, going back to that 49% of subs don't get paid, quote unquote, on time, it is incredibly hard to it's incredibly hard to dovetail what's happening with your payments with when you need to make those to credit cards. And then ultimately, if you're not successful in doing that, you end up in their 30% plus interest rate market. So, one of the things that we talk about when it comes to at least traditional AR factoring and credit cards is their focus is on increasing risk to offset rate. And so as they learn more about the risk, they increase rate. The challenge that we see with that is ultimately they have a kind of self-fulfilling prophecy of getting customers that are somewhat desperate and then therefore increasing their risk and then therefore increasing their rate. From a Struxtion perspective, as we'll talk about a little bit more, we believe that there's a better way to decrease risk and therefore decrease rate. And then, of course, GC discounts. I think some people recognize this as a tool. However, I would suggest that similar to factoring, it does come with some reputational risk. As many subs know, it is a typical standard operating procedure for a general contractor to pre-qualify a sub and know that they have the working capital available to execute on a project. And so the theory that they would approach a general contractor and say, hey, I need to get paid early has reputational risk. It's not a tool that's always available to them. GCs have to have a fairly stout balance sheet to be able to make those early payments. And quite honestly, it's not inexpensive. If you take 2 to 3% off of your invoice value for a 20 to 40 day early pay, your rates could be approaching 40%. What we believe is that, of course, banks represent the most conservative underwriting, and it results in the lowest cost. But unfortunately, they struggle to lend to subs. And so when we really have explored why banks I've underwritten, hundreds of millions of dollars of loans. And I always felt like I had a really good sense of what it would take to get a loan done. And I think what really opened my eyes to this space is you would take all of those same metrics and you would take all of those same deliverables that you would give a bank around a company in a different industry that you know was financeable. And for the subcontractor space, you would get a different answer. And as we pulled back the layers of that onion as to why, what we learned is really these three facets around collateral quality. One is the number one question every time I talk to a bank about getting a subcontractor financed through a traditional line of credit was, well, are these progress payments? And so this theory that it is not a discrete invoice in terms of it being a bill of lading with a certain number of units on it really has banks shy away from a risk profile perspective because they see it as being a bit subjective. Hey, I think I'm 25% done, or my numbers say that I'm 30% done. For a bank that doesn't have the same amount of it's not as discrete as what they normally see in an asset-based lending world. Also, paid when paid contracts, this theory, which is incredibly unique to the construction industry, of we are going to get paid from our customer, which is a GC, only when they get paid by their customer, which is a developer or an owner, which ultimately is not going to pay them until potentially the bank funds. And so this concept of this downstream risk really scares off banks because they don't have a way to understand kind of who's downstream and what the credit risk is. Really, the third piece of this is underwriting. We've explored this a lot, especially small to medium-sized subs, which is our target market. We believe that by supporting the small to medium-sized subs, we can help lift the industry because subs are in demand and it is a constraint for GCs. And there is a pool of subcontractors that can provide incredibly good value. But unfortunately, when they're capital deficient, they can't. However, if we have explored that, the credit reporting is incredibly deficient. And this is a tool that banks use pretty extensively. As we have pulled back many credit reports on many subs, it just does not seem to paint the right picture. Cash flow is difficult to analyze. And what I mean by that is it's lumpy. Some customers for banks that have AR that's being paid on a daily or weekly basis can recognize the smoothed out effect of paying your AP kind of mid-month as AR is coming in during the course of days or weeks. Unfortunately, in the construction space, your invoices are large and they come in basically every month, depending upon the number of jobs that you have. So we end up with this kind of lumpy cash flow that has high peaks and high troughs. And also there is risk predicated on job size. We've explored this quite a bit. The theory that if I'm accustomed to doing $200,000 or $300,000 jobs and I jump to an $800,000 job, I inject risk, which the banks have a tough time getting comfortable with, even though it means growth for the sub. From a loan management perspective, this is okay. We've understood the value of the assets and what we're going to lend against. We've underwritten the client. Now, how do we manage the loan? For banks in this space, it is incredibly difficult to stay within the collateral. And what we mean by that is if a subcontractor has $500,000 in AR, and as a bank, I'm willing to lend you $400,000 against that AR is changing on a continual basis. It has some of those downstream credit risk factors that we talked about under the collateral quality piece. And banks really don't have any way to kind of stay within that collateral and make sure that they are lending against the then current kind of AR. From a performance contract perspective, and this is something that we heard a lot talking with senior credit executives, was how are these contracts enforced? Are they in place? And when a sub invoices a certain dollar amount, are they generally getting paid that dollar amount? That is very important for banks to understand that if as a sub, they are seeing an invoice for $100,000, that general contractor is generally paying them for $100,000. And it's not, well, every time they invoice for $100,000, they're getting paid $90,000, because that just alludes to the bank that ultimately the client is trying to get ahead of essentially their cash flow needs. So, really, what is our mission? Our mission is to utilize technology and data to lower the cost of working capital and make it more accessible to the 680,000 subcontractors and what we focus on, which is the $860 billion commercial construction industry. So we're not specifically focused on single family residential and remodeling / kind of home focused type general contractors and subcontractors. We're focused on those subcontractors that are in the commercial construction space who are quite honestly at the at the whims of general contractors who have long and arduous payment terms given the nature of the industry. So, the overarching question would be, well, if so many other types of financial institutions struggle to lend to subcontractors in the space, what is Struxtion doing that's different, that essentially brings a lending type of opportunity, which is de-risked and cost-effective for subcontractors and accessible? So the first thing we do is on the collateral management side. We are bespoke to the industry, meaning we are 100% focused on subcontractors. We center our borrowing and our lending on the projects in the process. So we have a very good understanding of what it means to be progress paid, what paid when paid contracts mean, and quite honestly, the benefit of the people that as a subcontractor you're working for downstream. And this is part of our underwriting. So we essentially have a ledger-based scoring model. And in our model, we of course factor in the performance of a subcontractor and their historical performance and their current performance, but we also look very heavily at who the GC and the developer is. So when an invoice and a project invoice gets uploaded into our portal, we don't only look at the sub, but we look at the GC, we look at the developer, and the underwriting model that we've created takes about 25 or 30 data points to create a unique pricing against that project. One of the kind of analogies that we always use is an incredibly good subcontractor working for a terrible GC and an undercapitalized developer is actually less likely to get paid than a subcontractor who may, from a financial performance perspective, not demonstrate as well, but has been selected by a very good GC and a well-capitalized developer. And there's a correlation effect associated with that, which is general contractors go through fairly extensive pre-qual processes. If they've entered into a contract with you as a subcontractor, we believe that they've taken a lot of risk off the table. So we focus heavily on not just who the sub is, but who's downstream in that project to provide liquidity at the point at the project level. We engage the ecosystem. We have a preferred GC program. Part of that preferred GC program is to lower the cost to subcontractors. We're really trying to engage the ecosystem. We look to work with general contractors who understand that the plight of subs is somewhat unfair, in that not only are subs executing on all of the work, buying all the materials, delivering all the labor, they're also the ones that are supporting really the working capital needs of the entire project, while everybody else takes risk off the table. And I will say that we've been incredibly encouraged by the number of GCs that we've been in conversations with who recognize that their subs are their most valuable asset as part of their supply chain, and they want to treat them well, and they want to get them in a position where they're not thinking about capital, on a daily or weekly basis. Data analytics, so of course, as you can imagine, technology-based, using information to lower the cost. We pull information through essentially screen scraping or OCR. We use data sources that come from other parties. So not just what the sub provides us, but there are other information sources that exist in the construction space, people that we partner with, as an example, Construct Connect, that help us, essentially understand the risk within a project. And so when we get involved in a project and we look at the same kind of typical subcontractor cash flow, this is kind of where we believe that we step in with value, which is the typical cash flow being 80 days, as we spoke about earlier. We sort of inject ourselves into the process right after the subcontractor has invoiced the GC. We give the subcontractor the ability to take about an 80% advance on their invoice value, which is intentionally directed to help them essentially pay for their labor and pay for their materials for that given period. And so by providing this liquidity at the project level, we are able to essentially reduce that trough, right? That amount of capital that needs to be expended to execute on the same project. So taking the same chart that we talked about before and kind of layering in the Struxtion solution, which essentially is after submittal of the invoice to the general contractor, subs are able to take an 80% loan against that project, or at least that invoice. This is kind of the benefit that we see. And so the cash position changes dramatically. So from $489,000 to execute on the same project to $221,000. And so when we focus on this ratio of cash required to total GP, we ultimately see that we're now at 1.2 times. And so what does that mean for a sub? It means really, in our opinion, one of two things. Either they're able to take on a job that they otherwise would not have been able to take on because they didn't have $489,000 of cash or working capital available. Or if they did, they're now able to take on another job of a similar size and make another, $185,000 to $200,000. And so it really becomes about reducing the amount of capital needed during that 90 to 80-day cycle versus actually shortening it. So very simply going back to this chart, of course, we are looking to service subs who've not had the ability to build that track record that ultimately gets them to conventional financing, at least in today's world. And so, as you may have recognized when I showed this kind of graphic the first time, is just a big kind of abyss from this gold standard of 4% financing cost to 18% of the traditional factoring world. We want to sit squarely in the middle of that space. And we want to do it in a way in which and our business model supports this, is to allow subs to build credit while accessing credit. And so, one of the things that I've always seen with banks is their decision making is incredibly binary. They're going to underwrite you without any real accountability, without really accounting for rate. It's a binary decision. Either we're going to underwrite you to a yes or a no, and then at that point, they just lend to you at really whatever the rate is that the bank suggests. For us, it's not the case. We have the ability to obviously play within a slightly different rate market, but we are able to lend to subs to build credit while accessing credit. And the perfect example or analogy that I use is, when people first got their first credit card, the theory was, hey, you don't have a personal credit history. And, the best thing that you could do is go get a credit card. It's a $500 limit and it's an astronomical rate, but, the good news is that, if you pay it off on time, your rate won't be that high. It'll improve over time. And the amount of money that the credit card company is willing to lend you will improve over time after you build a track record of ultimately demonstrating your ability to be responsible, to borrow, and to pay back. And so our model is really built around that. As subs execute on the platform with us initially, and then over an extended period of time, we're incredibly transparent in how we score and how we price. And our goal is, over an extended period of time, we are able to continue to not only lower the risk and the rate for a subcontractor, but ultimately help them build a verifiable track record that if some point in the future they choose to go obtain access to conventional debt, we can essentially have that verified track record that can be provided to a bank to prove, hey, over the last year, I revolved, $1 million or $1.5 million worth of credit. And, here's essentially how it was done. So really, the takeaways for us are, when you look to manage your cash conversion cycle, it's really focused on two things. It's focused on managing the length, the number of days, and the depth of the cash outlay. And so clearly vendor terms, to the extent that you can be successful in getting extended vendor terms, helps shorten the amount of time. What I will say is that we do believe that vendors are obviously very sensitive to their credit rate and how they are accounting for those extended terms. So there is always going to be built-in pricing there. We believe that if you can lower the cost of that or the depth of that cash outlay, the ability to pay vendors and to take essentially early pay discounts will certainly just add to to your GP or your contribution margin for a project. Payments from general contractors, as we talked about, these are incredibly hard to really shorten. General contractors work on thinner margins than subs. They have a lot of volume flowing through the system, and ultimately they are also at the mercy of when they get paid. And so, getting an early payment from a general contractor, although an opportunity, is not consistent and can be costly, because generally there is a 2 to 3 point kind of deduction on the invoice value to essentially make that happen. And then, of course, utilizing a line of credit and all of these different financing vehicles to really not shorten the period of time, but to have you as a subcontractor laying out less of your own capital.